You probably heard the saying, don't put all your eggs in one basket. That's exactly why diversifying your investments is so important. Diversification ensures that if the stock market takes a hit, a reasonable portion of your assets still remains stable and secure. In this video, I'll share a simple yet powerful rule of thumb, the rule of 110 for diversification. I'll also explain how real estate investment could be part of this diversification strategy. The rule of 110 is a time-tested method to determine how much of your portfolio should be in stocks versus safer investments like bonds. It's simple. Just subtract your age from 110, and the result is the percentage of your portfolio to allocate to stocks. For example, if you are 20 years old, 110 minus 20 equals 90. That means 90% of your investment portfolio should be in stocks, with just 10% in bonds and other safer assets. But if you are already in your early 60s, 110 minus 60 equals 50, which means you should only have 50% of your investment portfolios in stocks, and the other half should be in bonds or safer assets. This rule adjusts as you age, reflecting changes in your life situation and financial needs. When you are young, you can afford to take on more risk because you have time to recover from market fluctuations. But as you get older and approach retirement, preserving your wealth becomes the top priority. That's when your portfolio shifts towards bonds and other stable investments. This rule has evolved over time. It used to be 100 minus your age, but with increasing life expectancy, it's now 110 minus your age. For people who can tolerate more risk, they even use 120 minus their age. Remember, the key is to tweak the rule to fit your personal goals and the risk tolerance. So where does real estate fit into this? Great question. Many financial advisors recommend allocating 10 to 20% of your portfolio to real estate. Because real estate is a fantastic hedge against inflation and often moves independently of stocks and bonds, helping to stabilize your portfolio during market ups and downs. Real estate doesn't fit directly into the stocks or bonds split, but it's a crucial component of a diversified portfolio. Investing in real estate in areas with stable or growing population can offer consistent income, such as monthly rental income and property appreciation, making it behave more like bonds by providing steady cash flow and long-term stability. For the ins and outs on how to invest in real estate, be sure to check out this video. Don't forget to subscribe to my channel. I'll see you with more investment tips in the next video.